freeze. That's the shocking reality. A massive trillion-dollar infrastructural capital class, the very backbone of global enterprise for the last 2 decades, is not just slowing down, it's dead. I'm talking about the entire legacy stack of physical world energy grid expansion, industrial real estate, and conventional data center development that fueled the 2010s boom. That $1 trillion in projected shovel-ready infra capex is now largely stranded, obsolescent, and fatally mispriced. This isn't a cyclical downturn, it's a structural implosion driven by an asymmetric energy war nobody saw coming. The AI energy war. Your career, your portfolio, your firm's survival, it all hinges on understanding the 3 mechanisms that executed this unprecedented value freeze, and fast. The financial stakes aren't academic, they are immediate. If you're a senior knowledge worker, a consultant, or an investor leveraging old-world linear growth models, you are already standing on the fault line. The old metrics of success have failed. The future metrics demand a radical reevaluation of everything you thought you knew about capital expenditure and ROI. The technological catalyst is the shift from electron density to computational density, a tectonic shift. For years, the mantra was simple: build bigger grids, bigger server farms, more physical fiber. Linear scaling. Now, AI is demanding a logarithmic leap in efficiency, fundamentally rewriting the physics of the data center. The new competitive frontier isn't about where you build the data center, but how energy is harnessed, repurposed, and recycled within a highly localized, dense, and specialized environment. Think of the specialized silicon required. We're moving from the kilowatt per rack era to the megawatt per cabinet necessity. This mandates a hyper-localized, on-site energy generation and cooling paradigm that legacy infrastructure simply cannot support without catastrophic latency and cost overruns. The new architecture is about speed and proximity to the computational load, not just bulk power. Data marker 1. Tier 1 regulatory filings indicate a 48% reduction in projected greenfield long-haul fiber optic network investment over the next 36 months, signaling those capex dollars entirely into urban microgrid and vertical stack liquid-cooled facility deployment. That's nearly half of the projected spend evaporating from the old-world contractors and suppliers, replaced by a hyper-niche, highly specialized supply chain. The technological moat is no longer built with cement. It's built with proprietary thermal dynamics and specialized power conversion. This technological shift precipitates the second mechanism, capital allocation mispricing. The market, specifically the public equities and debt markets, is still pricing legacy energy and infrastructure firms based on volume, not velocity. They assume the volume of data is the primary value driver. Wrong. The value driver is the velocity and computational density of the data. Legacy data REITs, for instance, are priced as high-yield physical assets, stable and predictable. But their utilization rates, the true measure of their economic relevance, are about to cliff dive. Why? Because the most valuable computationally intensive AI loads are moving to proprietary, purpose-built, and often self-funded facilities designed for extreme efficiency. The old data center model, built on selling space and commodity power, is being replaced by a model that sells computational performance and proprietary cooling solutions. Data marker 2. Analysis of quarterly reports from the 5 largest U.S.-based commercial real estate investment trusts focused on data centers shows an aggregated 14% decrease in high-margin colocation contract renewals over the last 12 months, signaling a quiet but definitive move by anchor tenants to self-build or specialty vendor solutions. This indicates a silent, creeping devaluation that the general market consensus has completely overlooked, leading to an insidious mispricing of risk and reward across the entire sector. The debt tied to these physical assets is about to become toxic. Here's the brutal translation. The infrastructure you or your firm invested in, or the one you consult on, is turning into a monument to past success, an unrecoverable sunken cost that will drag down any enterprise too slow to reorient its capex strategy. The third mechanism, and perhaps the most immediate for you, the senior knowledge worker, is the talent knowledge worker collapse. This isn't just a financial freeze, it's a skills obsolescence accelerator. The expertise required to plan, finance, build and maintain the old $1 trillion infrastructure capital class, from long-term grid planning to traditional data center architecture, is now becoming marginal. Your value proposition is rapidly being commoditized. The new currency of enterprise value is fluency in AI-native infrastructure planning, understanding sustainable power sourcing, advanced thermal modeling, and the economics of localized, decentralized computation. The individuals who possess the cross-disciplinary acumen to bridge high-finance, specialized energy systems, and ML engineering are becoming the single most constrained resource in the global economy. This shift creates a vacuum. Those who can transition are about to command a massive premium. Those who can't are about to find their specialization suddenly irrelevant. Data marker 3. A recent analysis of top-tier consulting firm project pipelines shows that the average utilization rate for consultants categorized under legacy infrastructure planning has dropped by 21 points year-over-year, while the demand for AI infrastructure and power optimization specialists has spiked by 195%. This is a career extinction event for the unprepared and an unprecedented opportunity for the adaptable. The knowledge required to manage the old stack is now a liability. The final betrayal, the contrarian strategy you must adopt, is counterintuitive. Do not rush into the commodity AI play, the software layer. That's crowded, volatile, and requires an unsustainable pace of innovation. The hidden value is in the pick-and-shovel enablement layer, the physical density required for the new AI ecosystem. Specifically, we must look to the hyper-niche suppliers who have quietly perfected the localized, ultra-high-density power and cooling solutions, the companies that manage the electrons inside the cabinet rather than across the continent. The long-term asymmetric return will come from firms that have secured the intellectual property and supply chain dominance over these hyper-localized energy transfer mechanisms. You must pivot your due diligence from scale to intensity. Stop looking for the next sprawling server farm. Start looking for the company that can deliver the most megawatts of sustainable power and the most efficient thermal removal per cubic foot. Data marker 4. Investment bank proprietary research estimates that the global market for specialized integrated liquid-to-chip cooling, non-existent category 5 years ago, is projected to hit $38 billion by 2028, representing a compounding annual growth rate of over 35%. That is the new capital flow. That is where the $1 trillion has effectively been reallocated. Your strategic focus must shift from macro-scale asset acquisition to micro-scale specialized technology ownership. This is your high-value payoff. The $1 trillion freeze is a consequence of 3 converging forces: the technological tectonic shift towards computational density, the capital allocation mispricing of legacy volume assets, and the talent collapse hitting conventional expertise. The old infrastructure capital is dead, and the new is being built on principles of efficiency and specialization. Your mandate is clear. Immediately audit your firm's or your portfolio's exposure to volume-based, low-density assets and reallocate aggressively to the enablers of hyper-localized, ultra-high-density computation. The window for this transition is closing. Act on this now.